3 mistakes I see 7-figure business owners and executives make over and over. And any one of them can quietly cost a portfolio this size 6 figures or more. You're probably making at least one of them right now. And number 3 catches almost everyone off guard. I'm going to walk through all 3 with you, calmly, no hype, and show you the one principle that fixes all of them. So let's get right into it. Let me paint you a picture I've seen a dozen times. We have a business owner, sharp, successful, trying to be 3 people at once. The entrepreneur, the father, and the investor. And quietly failing at all 3. Stressed at the business, distracted at the dinner table, carrying a portfolio he has no real time to manage. This isn't a discipline problem or an intelligence problem. In fact, these operators are brilliant, and you're likely one of them. It's a structure problem, and it shows up as 3 specific expensive mistakes that you're likely doing right now. And here's why I'm careful about this. At a few $1,000s, these mistakes are manageable, right? At 7 figures, the same mistake, same behavior, same blind spot is multiple 6 figures. The error doesn't get bigger. The position size does, though. So the goal of the next few minutes is simple. Name the 3 mistakes and give you the principle that sits underneath all of them. Let's get into it. Mistake number 1. Trying to nail the exact top or the exact bottom. Watch the loop because it's almost always the same. The price runs up and you tell yourself, I'll take profit at 125. And then it gets there and now your take profit is suddenly 130. 130 never comes, then it rolls over and you freeze. And then again, it bounces and you become euphoric again and miss to sell. So the cost here is rarely one bad trade. It's round tripping an entire move, riding a position all the way up and all the way back down, because there was never a defined exit. So you need a clear exit plan. And waiting for that perfect means you never actually act. So you need a clear exit plan and accept that you won't exactly get the top or the bottom, but you get close enough. And it's better to get close enough than not at all. So again, you don't need the exact top, you need a predefined plan. So let me be concrete about what a plan actually looks like, because most people have never written one down. It has 3 parts. First, where you take profit, and not one magic price, but across a zone. In pieces, so in trenches, you take profits and you scale out as strength appears instead of betting everything on nailing a single number. For example, you start taking profits at 110, 110, 115, 120, 125, like each 20% or 25% or however you want, but have a few zones where you have a zone and a few targets where you scale out. Then second, where you are wrong, a clear line that if it breaks, you act on no debate. So some line where you know, okay, no, this idea is failing, I have to go out right now. And third, how much is at risk in the first place? Position size decided before you're emotional, not after. And something on second where you're wrong on that line, for example, for last cycle, it could have been, your target would have been 130, 130, and 140. And the wrong one would have been some sort of retest of the 200-day moving average or whatever it is, or falling down again under 100K and then see a weekly close below 100K. That would have been a clear invalidation. We're likely not coming up again, something like that. So all 3 get set when you're calm in the context where we actually are in the cycle, and then written down. So the version of you that gets greedy once we get up there, or scared when we go down in the moment, doesn't get a vote, right? So you have that plan and detach from your emotions once we get there. Mistake number 2, and this one feels productive, which is exactly what makes it so dangerous, and especially as an entrepreneur and executives, it's very dangerous. Believing that more information automatically means better decisions. So again, believing that more information automatically means better decisions. That's mistake number 2. High performers default to add more inputs, more indicators, more newsletters, 20 browser tabs. It feels like progress, like you're in control, right? But more information rarely means more clarity. Past the point, it just means more anxiety. And with no time, all of it gets consumed reactively, usually in the worst possible moment. Between meetings, late at night, at your child's tournament, whatever. So when you're already stressed and the position is already moving, it gets tough. That's noise hitting an emotional brain, and it makes a time-starved investor worse, not better. By the way, if you need help with this, make sure to check out the first link in the description or pin comment to book a one-on-one strategy call with me. Back to the video. So here's the part nobody admits. With 20 inputs, you can always find one that agrees with whatever you already wanted to do. So more data doesn't reduce your uncertainty. It just gives you more sophisticated ways to justify the emotional decision you were going to make anyway. That's not analysis. That's confirmation bias with extra steps. And that's what happens to a lot of intelligent investors, executives like you. You're intelligent, you're smart, you know what you're doing, and you read so much. And at the end of the day, you kind of trick yourself, right? So it's at the end of the day, it's just confirmation bias with extra steps. That's it. Because you're also not like just some retail trader, right? You're more than that at the end of the day. You're managing hundreds of thousands, if not millions of dollars. And then the 10 indicators. 10 indicators at the end of the day, they will also contradict each other on any given day. So without any hierarchy, you either freeze or you cherry pick one that tells you what you want to hear. So same thing again. And most of what you're consuming anyway is retail noise. It's an echo chamber built on incentives that have nothing to do with you. The platforms reward certainty and drama, not being calibrated and right over time. I don't know, let's wait for confirmation gets no clicks on YouTube or X, wherever you are. So 2 questions cut through almost all of it. Does this indicator actually have a track record on this specific asset, or does it just sound smart? And then what's the source's real motivation? Being right over time or getting views and volume today? So these 2 questions are very important for you to ask every time you do your research or analysis. So the fix isn't more, it's a filter. I run everything through 3 pillars. 1, that's technicals, but only the ones with a real track record on the specific asset class over decades. The ones that tell you where the market is headed months and years out, not minute to minute. So 2, sentiment and psychology. The actual emotional state of the people still in the market and what's shifting it. Then 3, macro. Not the headline, but what's underneath it. So why did the insider buy and how much? Or what's the dollar doing and going to do probably? What will the new Fed chair actually do, judged by their track record, not their promises or headlines? Very important to dig deeper here. So you combine all three signals, and you get a calm, calculated read instead of a reactive one. That confluence is the whole point, and it takes a couple of hours a week, not 10 hours a day. Using my exact 3-pillar framework, I was able to read the markets well enough to understand that the regimes changed back in summer of 2025. Based on the analysis and research, as you may remember from other videos, I've shorted Bitcoin at 120,000 and many times since then, and called tops and bottoms over the last 5 years, be it in the stock market or in crypto. So mistake number 3, the one almost nobody flags, idle cash. This might surprise you. Most 7-figure portfolios have a meaningful chunk of cash just sitting there. And the assumption is that cash is safe. Cash is king. But sitting in full cash through the wrong part of a cycle has a real opportunity cost. It's capital with no job. Now, I want to be fair here. This isn't for everyone. Some people generally want everything in long-term core positions, and that is completely valid. I'm not telling anyone what to do with their money anyway. So for those who do have capital they want to put to work, volatility stops being a threat and becomes an opportunity, your best friend. But only if there's a disciplined, macro-driven process behind it. And to be precise, this is not day trading, and it's not living on the screen. This is something you can't do anyway as a business owner executive. You can't be a day trader or anything like that. It's a small number of high conviction, clearly defined moves a year. So just a few moves a year. The principle isn't a number, it's this. Idle cash has a cost, and a process gives that cash a job. I personally decided to use Bitcoin as my main cash flow vehicle in trading. I take about 8 to 10 larger trades on Bitcoin per year, as you may know from other videos. On average, they make about 33% without leverage. For example, the recent pullback, I took a public short from 82K. My average entry was 81K at the end, down to below 60K, or the long from 84K to 97K, or my public short from 120K to where we are now. So a few of those low risk, high reward trades give me a great amount of cash every quarter. And that's what my idle cash is for. I use it. So it turns from idle cash into active cash flow. Step back and look at all three together. So chasing perfect, drowning in information, leaving cash idle, they look like three separate problems, but they are one root, and it's no system. No system means emotional decisions. Emotional decisions mean no clear plan. Fix the root, and the three mistakes take care of themselves. So let me show you at a high level what a system actually means, because it's not a magic indicator or a guru you follow. The way I run it, every decision passes through the three pillars before it's a decision at all. So again, we have the macro, what's actually moving underneath the headlines. Then we have technicals, the only ones with a real track record on that specific asset over decades. And then we have the last one, sentiment, the emotional state of the people still in the market. When the three line up, you have a signal. When they don't, you just wait, and waiting is a position too. Sitting above all of it is the cycle, right? So the system isn't married to one asset, it's built to read the regime we're in and rotate accordingly. When to lean toward risk, when to step back toward cash, where capital should actually be working. And the goal isn't to nail the exact turn, it's to be approximately right at the big ones with a plan instead of perfectly wrong with none. And because it's a small number of high conviction reads, not 8 hours a day of day trading and watching the charts, it fits a life that already has a business and family in it, like mine. So a couple of hours a week, not a second job. That's the whole shift. You stop being the reactive investor in the story and become the calm one with a process, with something acting as the mirror so greed and fear don't get to make the call. The entire game is replacing reaction with a process. So quick recap again of the whole video. 1, chasing the perfect top or bottom instead of acting on a plan. Then we have 2, confusing more information with better decisions. Then we have 3, leaving cash idle when he could have a job. And one root underneath all of them, the absence of a system. If you've got a 6-figure or 7-figure portfolio and you're a busy founder and executive who wants help building this kind of system, book a one-on-one strategy call with me. The first link below in the description or pinned as a comment. On that call, we'll walk through where I think we are in the cycle, how the framework actually works, and whether it's the right fit for your situation. So that's it. God bless you.